All right, so without further ado, Josh Schoenly, Jordan Syers, gentlemen, happy Monday. Thank you guys for being on. You two gentlemen are incredible when it comes to all things mortgages, and you guys are both with NEXA. We've had the pleasure of working with you guys for a few years now, and with all of the changes in the market, I can't think of two people who are better at understanding how to adapt and then being at the forefront of how to leverage some of these, market changes for the benefit of us. So I want to thank you guys both for being on today.
Well, thanks for the invite and the kind words.
Absolutely. Yeah, most definitely. So as we kind of talked a little bit, we are going to dive into the assumable mortgage. And like, man, we're just here for it. We understand the strategy. We know that there's a lot of opportunity there, but there's a lot of mystery around it. And there's a lot of like gaps in how to actually go from finding the opportunity to actually closing so that the buyer can take on an assumable mortgage. There's a lot of things to consider there. So we're really interested to better understand from you guys what some of those options may be, and obviously, most importantly, how to go out there and market this so that we can all win together.
Yeah. So my thought was, we'll take some time to cover what types of mortgages are assumable, the nuts and bolts of that, and maybe the pros and cons.
Yeah.
And then
absolutely.
the biggest piece of the puzzle, in my opinion, is how to, it's a wonderful idea in theory, but how do you take that and actually make transactions work? Particularly, how do you get the seller their equity? Because the seller who bought in 2021 and locked in a low rate has also most likely now has a lot more equity, and they're not just willing to give that equity to the new buyer. And so to ensure that we're able to offer an assumable and yet still get the seller paid and have the biggest potential buyer pool. Probably. Yeah, the piece of the puzzle that's the most valuable. So Jordan, let's start. If you can start by, what mortgages are assumable and how does that work? Big picture wise.
So fun fact, I'm actually in the middle of assuming a house myself right now. So
congratulations.
I'm in the middle of assuming a mortgage. So it is a process. But in the regards to programs that are assumable, it's gonna be government programs, FHA, VA, and fun fact, VA, you don't even have to be a veteran to assume. Okay, and then USDA. Conventional does not apply. Okay, so that's really the only program, and non-QM products don't apply. But these three programs, they all have some sort of an assumable clause in them. And anybody can go in, and as long as they qualify, they still have to traditionally qualify. And when I say traditionally, there's a key part here when you try to qualify for a assumable mortgage. It is a manual underwrite. It's not a traditional way that you would normally get someone qualified for a mortgage, where you run AUS or run desktop underwriter and you get approved eligible spit out. It's more or less a human, and you're going to go to base FHA rules. It's not going to be based off of probably a traditional loan that you would see someone. So what does that mean? Tighter requirements. They have to prove the last 12 months of their rent history. They have to adhere to a 31-43% back-end ratio unless they have compensating factors. And the max it'll go up to is a 40% front end and a 50% back end. Okay. So that really took me by surprise when I was in the middle of my process. Okay. Because it's much different, requirements. They time frame wise, I would say they're a lot longer than people realize. I would say mine will probably take 7 months to complete in all. It depends on how busy the bank is. So it's not like you're going to come to me as a mortgage lender and say, hey, Jordan, I want to assume this house. I'm going to tell you, you need to contact the servicer. right? You and the seller need to contact them, and they have to give you permission to basically talk about that loan and how that assumable process is going to go. But it depends on that servicer and how backed up they are. Typically, Assumption Mortgage right now are, they have departments, they don't make a ton of money off of them. Like the assumption fee that I have is only $900, right? They're not, willing and dealing these and making a ton of money. So I would assume most companies are backed up, but it's really going to depend on the company. The company I'm with, it gauged about a 4-month process, and it's looking like it's going to be closer to 7 to 8, somewhere
Wow.
around there.
Jordan, would it be fair to kind of compare it to like the short sale process? Like
Yes.
there's
Yeah.
no the
There's
banks
no
aren't
one
just
that,
lining up excited as you're the low priority on the list of priorities there.
yeah. And what I've seen on, I'm a 10-year veteran in mortgages. And what I've seen is like when I contact them, a lot of them, they don't give a lot of information of what you need to have when you first start. So there's a lot. So what I tell people when you first start is you have to try to gauge your closing costs, which for, a buyer of yours, there's no way they're going to be able to. So I would say anywhere from make sure they have $5,000 to $10,000 in the bank. They're going to set a meeting up with that first, with their first meeting with the a loan originator, so-called originator, I don't want to, technically loan originators, but they'll have a meeting with them. If you don't have the cash right then and there, they cancel your application. Like if you don't have your money pulled from your 401k or you don't have your money transferred in the right bank account, you have to have it ready and to go. That's another thing that I found is if you don't have all your ducks in a row before you even have your first meeting to find out what ducks you need, they're going to cancel your application. They're going to tell you what you need, and then you're going to have to schedule again, which is a month or two later. So you want to try to advise your clients as, hey, make sure the money, wherever your money you're going to pull for your closing costs or your equity needs to be in a bank account that you have access to and that you can provide. Make sure your W-2s, pay stubs, banks, all of it's put together at that point.
Jordan, can I ask you really quick? Is
Yeah,
this what
shoot.
contributed to your timeline, like having to
Oh
go
yeah.
through? Okay, got it.
Oh yeah.
So this is
Yeah,
why it's an extended period.
yeah, it's and that might be just with this servicer. This servicer is Freedom Mortgage. So
Okay.
if anyone have Freedom Mortgage, it's they're a fairly big servicer, but that did add to my timeline in general, which I thought I knew they were going to be longer. I thought, maybe 3 months, but to me, I could see someone that's new or maybe it's a realtor because it's just you as the real estate agent that's trying to guide these people. There is no real mortgage lender that's in this. So I could absolutely see a client going back and forth and having to kind of reschedule their meetings. And their meetings are about a month and a half out each time.
Mm-hmm.
So yeah, absolutely. I think it will contribute to their time frame. So the more information I can give you, the better in the terms of what they need to be prepped for. But it's going to be the traditional documents of W-2s, pay stubs, bank statements. Those bank statements need to show their funds to close of where that money is going to pull from. And gauging what your funds to close are, there's really two aspects. There's not going to be a whole lot of closing costs besides title fees, escrows, and usually a assumption fee of $900 or some sort of assumption fee. It's usually not too much. And then that's really it. There's no appraisal involved or anything along those lines. It's just those fees in general. With that being said, you also have to buy out the equity, depending on how you negotiated it. Some people negotiate a lower price and they don't have a lot of equity to buy out. Some people don't. Some people it's full market value. So depending on when that house was done, whether it's 5, 6, 7 years ago or 2 or 3 years ago, I got lucky and mine was like a year and a half ago, and they were just right at the end of the 2.99 interest rates or 3.9 interest rates. And so I skirted in there. So there wasn't a ton of equity, to buy out, but there was still some, quite a bit. But they can either pay that cash or they can get a piggyback loan or the seller can finance it. Okay. Depends on what it is. I did mine as a split. I did mine as partly a seller finance and a partly buy out the equity. So I bought out half as equity, and then I did a seller carryback for the difference.
And did you just was your piggyback both second and
No, I paid cash.
got it.
I paid cash
Can
for it, and then the seller paid back. It was just easier.
Yeah, that makes sense. Can you do that? Is that a possibility for the two ways in which to be seller carry
Oh
and
yeah.
a second?
Mhm.
Okay.
Yep. So depends on what your piggyback requires for equity position wise. Um, but any piggyback loans usually are anywhere from 5% to 15%. Just depends on credit score, position. I usually recommend people that are doing assumptions to have at least a 680 credit score. I know they don't have to qualify for the assumption. Uh, uh, for example, FHA goes down to a 500 credit score. Most people don't realize that, but they do. They go down to a 500 credit score. But you're not going to get a piggyback loan with a 500 credit score. You're going to get a piggyback loan more like a 680, 660, somewhere around there, depending on how much they want to put down. So the higher the score, the better, definitely.
And then, so I definitely want us to dive into some of the products that you guys have at NEXA and how you guys could help navigate with that second mortgage, because that's where you would come into play, right? If someone was buying a home and they're making, or they're assuming the sellers first, but they need to bridge that gap. And I hope everyone's clear. The challenge is if someone bought a home 3-4 years ago, and let's say it's worth 600,000 now, their first mortgage might only be for 350 or 400 because of what the value was back then. So that's a significant amount of money that you need to either come in with cash, as
Oh yeah.
Jordan mentioned, get a second loan and or seller financing. So therein lies the challenge, but that's where these gentlemen are coming with a solution, because they can help with that second mortgage, so they can assume the first and then take on a second mortgage to bridge that gap and give the seller the ability to take that equity out of their home. That's why they're selling it, right? Instead of doing a seller carry. So let's dive into some of that, because I get what you're saying, and I really appreciate like the simplicity around it. If we're just talking an assumption, there is no lender. We don't get to say, hey, Jordan, come help us with this assumption loan, because there's nothing there for you. In fact, that's even true of the servicer.
Yeah.
There's no win for them, right? That's already an existing loan, an existing file. I don't think that $1,000 fee, if you will, or sub $1,000 fee is going to be a big motivator for them to want to go and originate these.
No, they're doing a lot. I mean, it's usually one person handling 40, 50 files, right? It's definitely a process. I don't know how the best way to say that, but it's definitely a process. Yeah, it's definitely a process. But in regards to what products that we have to help with it, we have a 5-day HELOC. I still recommend people anywhere from a 660 to 680. That's pretty much any bank that you're going to go to on a second mortgage is going to fall into those parameters. There are instances where it does go lower, but you get to the point where you're putting, the LTV requirements is like 70% loan to value before they'll even touch it. With that being said, the 5-day HELOC, you get your money in 5 days. You could technically do a piggyback with that. You can also do a piggyback with a company that we have is called Spring EQ that we run through, and they literally have an assumption process. It's a process that you would get pre-approved ahead of time, where on the 5-day HELOC we would not. Right? It's essentially done. They would apply that days before, which is not necessarily the best idea, right? So Spring EQ is a little bit longer process, but you start that process, get pre-approved before you even start the assumable process, and you basically, your loan just sits until it goes to completion, and then they will do a resubordination once you close, and basically just take that loan and put it on a second lien position at the same time as you're closing the assumption.
And if you were to piggyback in that way, so 2 questions. One, I'm assuming that means we just come to you guys, right? You guys do the pre-qualification like you normally would underwrite a loan and position the borrower for that.
We would just need, so the process wise, you would want first, so let's just take it, as is listing agents are promoting this a lot more than I think a lot of them realize how much it takes to actually do.
Yeah.
Let's just say you get one and said, okay, we'll start this process. All right, great. You'll want to get your client in a position where they're talking to the assumption department. They're basically going to call together. I don't know if you guys want to do a three-way call with all clients, but they have to call together and give them permission to talk to them freely. Once they get permission freely, you're going to go and get a mortgage statement. Once you have that mortgage statement, I can do everything I can on my end. Like, I can't do anything until I know how much that payment is, how much they owe, how much equity we need to do. And that's really either we ask from the buyer's agent or the listing agent, hey, can you give us a statement up front, or can you start the assumption process? Either way would work. I just need to know how much they owe and what their monthly payment is, because that's going to go into their debt to income ratios. And then we can start our process and see what happens there.
Awesome. So, someone finds a great property, they want to move forward, they have this piggyback option with you guys, and that would help because now we have you guys who are clear about this process in the driver's seat because there is that secondary mortgage moving forward. When that happens, is it helpful that you guys would have the ability to also prep that buyer for I know that that's not your responsibility in terms of
yeah, I would prefer it, to be honest. Not that I don't think a real estate agent couldn't do it. They could. But like what are they going to need? W-2s, pay stubs, bank statements, tax returns. It would be it would be a process. It's probably a little early for us to talk to them, but I probably would prefer that. We don't get enough of them that I mean, let me put it this way. It's such a complicated process. I've done like a few in my career in 10 years. It's not an easy process to complete. And really what happens is they go out and find a house, and then they start the process. And then I think the sellers and listing agents realize a lot of times how long this is going to take. And they're like, oh no, I'm about to tie up this house for the next 6 months, or they don't realize it and they're very aggressive towards you guys of how, get it done quickly. And it's like, hey, it's your bank, it's not ours, kind of thing. But so I would say most of the time that is the reason why people back away from these, is the time frame. But you could also be working with a really great bank that could take only like 20 days. I don't know. I just know from my experience and what I've seen in the past, it's usually not a 30-day process. It's a much longer one.
Which is a great segue. So this is a really good opportunity for us to like switch gears a little bit. And I guess I have two questions about this transition. One, on the listing side, what could we potentially do on the listing side when listing a home that has an assumable mortgage that could make sense to figure out what things may look like? And then number two, how do we both market this opportunity in a way that gets people off the fence, but put them in a process that helps them understand just how slim of a chance this process would make sense for everybody, including them as a buyer, but get them ready to go to buy anyway. That makes sense.
Yeah, no, it definitely makes sense, because it's one of those, not that we want to hook them and bring it. Everyone has an option for this, but at the end of the day, it is a slim chance. And it's something that we would probably, if you didn't market, you could get buyers, let's go out and look at assumables. And then I don't know if you want to do a presentation, what it would be or what it would look like. But prepping them in general to buy, it's probably going to be harder for a buyer to buy under an assumable mortgage, just qualifying wise, than it would be for a traditional mortgage, just because they're manual underwrites. Okay. So, I know that's answer your second
Jordan,
question.
can you take a minute and explain why that? Just so folks, because I mean, I know you said that already, but like, the automated underwriting versus manual underwriting, why is that? Why is it more difficult? Manual underwriting.
Hold on, guys. 1 second. I'm gonna change my camera. My camera's getting a little hot. I don't know what's going on with that. So I would say the biggest difference is a human is going to review them. I mean, that's the biggest difference.
So you have actual eyeballs scrutinizing everything.
Yeah. So when I'm doing a manual underwrite in general, where I'll give you an example of how it can be difficult. Let's say you do a manual underwrite and you have to track 12 months of rent history. Typically, if it's a company doing it, we typically can do what is called a verification of rent from that company. They sign a piece of paper that they paid on time, and then boom, we're done. But if it's from a personal owner, let's say it's from let's say, Josh, you don't have a company, you're just renting a house to somebody. I have to track 12 months of payments of their bank account. They have to provide me bank statements for 12 months, and I have to highlight where it came out and prove that it was on time. That's an example of how a manual underwrite can make it harder than an AUS. An AUS would never even require that. They don't require proof of those things, typically. That's just one example, but also the scrutiny of the ratios, where the maximum back-end ratio for FHA, and when we're talking about ratio, it's just the overall debt they have compared to their income. It's done in a percentage. The max for FHA is 56.99. That is the absolute max. Okay. It knocks down to 43 initially on a manual. If you have compensating factors, which is 3 months reserves, reserves are the monthly payment in the bank account. So if the payment's $2,000, if 3 months reserves would be $6,000 over and above what they need to cash to close, is just sitting in the bank account. If you have 3 months reserves, that will go up to a 40% front end, which is of the payment, and 50% back end. So even then, it's still a 6.99% shave off what someone could qualify for. So it limits your ability, but also, I'll give you an example. I've closed a loan where someone was currently behind on credit cards. Okay, in the 500s. It's doable with automated underwriting accepts. With a manual underwrite, they can't have anything negative, collections or late payments in the last 2 years. So that's another overlay. They're going to look at it and say, hey, 2 years ago, you had a late payment on a car payment or a credit card that you might have missed, where traditional financing would probably not even bat an eye. If you got an AOS accept, it's no one even, asks about it. Where a manual, it's an automatic decline, So it's little things like that that would make it more difficult.
So it
I just wanted to
literally
double
is.
tap on that before we go into Joseph. Sorry.
No,
So
go.
Now
Please.
I think there's the two pieces of the puzzle here. How do we have these conversations with sellers and use that to get ourselves in more conversations and create more listing opportunities? And I think also more importantly, set realistic expectations with your sellers. If we're going to include this in part of your marketing, so that it doesn't have the reverse effect that you hope that it has for you. And then how can we use it to convert more buyers or get more buyers in conversation with us, pre-approved and out looking at properties.
Bingo.
So Jordan, do you want to start there or you want me to?
You can go. Yeah.
Well, so I mean, I think for the seller conversation, number one, when you're talking with sellers, either doing the homework to, if you're using a data provider, or if you can find the data, sometimes MLS has the information available, or they have a partner on the data side. For example, Bright MLS, which is what I have access to. We have Remind. I can pull up a property and I can see when their last mortgage was, who it's with, and in some cases even the estimated rate. I mean, it's a little bit funky, but just so you have an idea, you're educated a little bit. Is this a conversation we should even have with the seller, right? Like, is this even a worthwhile conversation? So that's number one. Number two is, if you can't find that, or even maybe you have an idea, you confirm that information. Okay. Number three is be incredibly transparent with some of the things that Jordan already mentioned. This is one way that we can potentially drastically increase the buyer activity and interest in the property. Yay. On the flip side, if we have to be closed and settled in 45 days because of X, Y, or Z reason, let's not even go down that road, because all we're going to do is we're going to end up frustrated, and or the buyer's going to end up frustrated and feel like it was some sort of bait and switch.
Yep.
right? So like making sure that that's all, you know, ducks in a row. Then, you know, if there is the flexibility on when they're going to move, and maybe it's for whatever reason, it's a harder to sell property, right? It's not you know, it's not one that's just going to be a slam dunk. We listed on Thursday morning. We have showings all weekend. We've got multiple offers Monday that we're reviewing and getting highest and best, right? Or maybe it's a property that they've tried to sell, right? You're the second person that, you know, the second listing agent, right? They tried before and whatever reason. And there could be any number of reasons, right? Whatever. That is where I would look at, does this make sense? And should we include this in our marketing plan for this specific listing and the property? And then if that is part of it, then doing some of that initial due diligence that Jordan mentioned, finding out from the lender, who do we need to contact? Right. So we're, you know, and being transparent with the lender, Jordan, you would say, right? Like, you know, the borrower saying, hey, listen, we have to sell our house because we're doing X, Y, or Z. We have a, you know, work-related move, whatever. We would like to be able to offer it with the, you know, the current underlying mortgage, you know, assumability clause. Who do we need to talk to about that? And what's your, you know, your servicing department's steps for that, or their,
they'll have an entire department dedicated to assumptions, right? So when I say the entire department, it's probably a few people, but it is a department, and they'll transfer you over to there, and you can ask on what kind of length are you looking, what's the average length. They should be able to answer that. If they're not able to answer it, most likely you're going to have to set up a time to talk to a loan officer, and that's usually 30 days out. So,
and I would, whatever they say, I would probably prep your seller. We probably want to plan for more. They said 20 days, probably want to double it, or at least 1.5 times, right? If they say 20, let's say 30. And the 20 days might be to get the first appointment, like Jordan was talking about, right? So just, again, I think it's incredibly important. Transparency is incredibly important here, because you don't want to, everything in life is about setting and meeting expectations, right? Yeah. So if you set the proper expectations, all is good. If you set the wrong expectations, then you've got to backtrack, and you end up doing more work than necessary. Where I think, you know, more and more we live in a world that if you're transparent and you set those expectations, you know, you're protecting yourself and your client and the, you know, the potential buyer client in the scenario. Before we pivot to the buyer side, does that make sense? Jordan, do you have anything to add? Does anyone have questions? I forgot to mention at the very beginning, certainly, if you have questions, if you have scenarios, there's no, you know, there are no silly questions. There are no, there's nothing off limits here. We're an open book when it comes to this stuff, because we want you all to be educated and confident enough to use what you're learning here to have better and more conversations with potential clients, listing or buyer side. Because not only I think our sellers going to become more aware of this strategy, but buyers too. Yes. So you've got to be educated when they start asking about it. You want to be able to give educated responses. Yes, that is possible. Here are the pros and here are the cons. You know, do you think it still makes sense to continue to explore this? And I would say that the availability or the number of listings being marketed with assumables, I think, is going to be drastically different depending on market. For example, Pennsylvania is extremely conservative. It is anything outside of this little box, when you're conversing with native Pennsylvanians, or I'll just even say native Northeasterners, it's a hard road, right? If it's not what they know or think that they know about X or Y or Z, well, Uncle Billy told me that's illegal. You know, like, well, okay, let's just relax here, right? So, but in more, what I would say, more progressive or more even like more tech savvy markets and so forth, they already know about it. They already they've already maybe done some of the research on it. And I would say even the markets where the agent population is more tech savvy and creating more content to educate the public you might see it be more prevalent than, again, here in central Pennsylvania. So anything on that before we pivot? Anything to add to that before we pivot to the conversation on the buy side?
Yeah, any questions from anybody?
And obviously, you guys can open your lines too. We don't have to just use.
It's still a great marketing tactic. I know I set that up as oh man, that's kind of a long period, but it's still a great marketing tactic. It's something that we talk about people with. I have those conversations constantly with buyers, if they decide to go this route. And if they can get it, absolutely take it. Like that's what I tell them. It's like it's a knock out of the park if you can get an assumption mortgage for a buyer.
Yeah, I agree.
And
And what I don't want to, oh, go for it, James.
Yeah. So, Josh, I mean, you obviously market, or do you know anybody? Are you marketing on your listings that this particular property may, has an assumable loan, and and then getting them pre-approved for traditional financing, or and giving them the two options, or what is the strategy that you find working for you?
I will say personally, I have not had to, because all of the listings that I've had recently have been just the easy. I know that if we do how I normally operate, literally all of the last for as long as I can remember, we put it up on a Thursday or Friday morning. We show it all weekend. We've got multiple offers, and away we go. And there hasn't been the necessity to explore this to increase exposure and interest. However, that's not going to last forever. Right. And I also know, again, just like I said, we're conservative. It also means that we haven't seen some of the, drop in activity or even like drop in appreciation, et cetera, that some markets that are a little bit more aggressive or whatever word you want to attach to that. So I just personally haven't had to have those conversations. Now, that said, I had buyer clients recently that the seller was offering, and it was smart on their part because the property had been sitting. My clients could not qualify for the assumption. And they actually ended up they owned a property free and clear. They refinanced that property to then use and just bought this property in cash. Right. So it's not that I haven't seen the strategy being used locally. I personally haven't had to have those conversations yet.
Gotcha. So second part to that real quick. Do you think it's a way that a seller could get more money than what market is because the monthly payment's going to be lower and somebody's willing to pay a little more to have that interest rate?
I've explored that a little bit. It depends on the equity position. I think when you're looking at the equity position, you have to realize how much a second mortgage costs, right? Dollar for dollar, right? If you're getting a 14% interest or 12 or 11 or 10% interest on a second mortgage, and you are more than 50, you're pulling 50% of the equity, it might not necessarily make sense. And even if it's above that. Now, if it's cash, I've seen before that they've had selling at a higher price to get the lower rate. I've seen it happen before, but I'm not usually notified too often of those because I'm on the lending side. I would be completely out of that if they had cash, right? I'm not involved in it. I just know that it exists, and I know a loan officer, in particular, that sold their house on an assumable mortgage. They knew how long it was going to take, and they offered them I think it was like $20,000 or $30,000 more, and they were able to buy out the equity cash. But they also did an owner carry situation. When you're buying out the cash, they did owner carry. They got the equity that they wanted up front. They did an owner carry situation. They moved on, and that's also, an option for someone that's buying out, the cash and getting the, lower rate. You could do an owner carry type situation. So it is possible as long as they're paying cash. Now, if it's on a piggyback second mortgage, they're going to figure out what total loan to value is. They're going to do a drive-by appraisal or something, or AVM, And they're not going to go for that. They're not going to typically allow you, to purchase a house more unless you have enough money down.
Yeah,
Does that answer your question? Yeah.
Makes total sense. Thank you.
Mm-hmm.
I want to get into the weeds with one thing before we pivot to the buyer side of this, because I think that there's a ton of value in the buyer side of this. Actually, two things. So while we were chatting here, because I'm curious, I was curious, my own curiosity. I logged into my MLS. I chose the 4 counties that I primarily serve, which, by the way, we're here in central Pennsylvania: Cumberland, Dauphin, York, Perry, and the surrounding areas. We'd love to help your clients. There are 0 properties listed that have like acceptable financing, because there's like those options. Assumption, there are 0 that note that in those 4 counties right now for me. Now I'm in a very rural area, so literally if I just select all listings available in those 4 counties, there's maybe 1,000, maybe. I could look here in a second to confirm. So it's not like a lot, but that just, I don't know. That was kind of like a follow-up to James's question for me locally here. Now, one strategy, once again, I think the value in this is harder to sell properties or already failed to sell properties. So for example, you go on to PropStream. I love PropStream as a data provider. You can go on to PropStream, pull up all the failed listings last year, 2023 failed listings. And also you could add in the filter, have an FHA, VA, or USDA mortgage. You've got a list of where you can you could, in theory anyway, have a different conversation with those sellers, right? I've got a unique selling strategy that you probably didn't explore when you were previously trying to sell. If you're still thinking about selling, I would love to review that strategy with you. Okay, that might be, one in the weeds sort of tactical application of that strategy, or maybe even for sale by owners that are struggling to sell. Right, you just do a quick little search. Do they have a government sponsored mortgage?
Or use your title rep. Your title rep company can pull these, most likely to sell VA, FHA, USDA loans. Let's look at 2020. Look at those and see possibly most likely to sell.
I always forget that because again, I don't know if it's just like a Northeast thing. I can't get that data from my title companies. That I've tried. Everybody like in nicer, friendlier states, or I don't know what the difference is, but none of the title companies that I work with will offer that. That's why I pay for the data to get some of this stuff.
But it's usually for a fee. Even with the title companies, they call them premier services.
Yeah. So, but worth exploring, worth asking the question. I mean, worst they can say is no. So on the other side, how do we use this to maybe help more buyers or get more conversations with buyers, et cetera? Jordan, thoughts on that? And then let's maybe, you kind of mentioned some of the criteria. If we are going to pursue, we've got a willing seller and we're going to pursue that, and we've got a buyer. They've got a little bit of cash, but they got to make up a big equity spread. Maybe there's a $200,000 to $500,000 equity spread. How are we gonna do that? Let's circle back to confirm some of those numbers as well.
In the terms of a buyer, I need to make sure that I don't tell you to do anything to break laws.
Well, here's my thought on how you could use this to attract buyers.
Okay.
And it's why I went into my MLS to see. If you go into your MLS and you can pull a list of properties that have assumptions available, you could offer that as a marketing concept or hook to get interested buyers. Hey, did you know that right now in blank county, Baltimore County, Maryland, there are 35 properties available with assumable mortgages. If you'd like that list and to explore how you might be able to purchase one of these homes by assuming the first mortgage, go here to check it out, right? So that's like a way that you could use it as conceptually to maybe get some buyers engaging and conversing and interested. When they are, or when they do, and we've got a willing seller on the other side, how do we so we talked about closed-end seconds and HELOCs, Jordan, but if you could reiterate, what are they going to, and we're obviously going to review this with the clients, but just as folks are having conversation with them, what should they be aware of to qualify for that type of secondary financing?
Income wise, they're going to want to qualify for the assumed payment, because the assumed payment's it's a static number. It's the same number no matter what. It's been the same number since they pulled out that home loan. It's the principal and interest of the current insurance and taxes. Okay, so there's the other thing. Some of you are in California, right? When taxes would be reassessed, wouldn't they, if a house is sold or title changes? So you got to take that into account. But also, whatever the new second mortgage is, I would use typically my rule of thumb is going to be around 10%, for that. And income wise, 50% and below DTI, debt to income ratio. I know a lot of times I throw out debt to income ratios. I know most of us are real estate agents in here, and you probably don't think in those terms all too often, but they have to make at least double what the payment is. Okay, to put it in simpler terms, is if the payment is $2,000, it has to be at least 5,000 roughly or up, 4,000 roughly and up. So in the terms of qualifying credit score wise, 660 to 680, and then yeah, that's pretty much those two things.
So
and
the
then
three pillars
assets
would
are
be
it's
income.
gonna depend on how much equity they have and what the plan is, if they're gonna pay it out of cash. So yeah, so income
Nick, it
wise,
relates to the three pillars that we talk about with financing all the time. Income, right, which is what he was talking about, DTI, credit score 660 to 680 plus, and then assets. It's going to depend on, are we trying to get the maximum amount of leverage, or do we have some assets to play with to slice up how we get the seller their equity?
correct. I would say one of the big tricks I have, if they're paying cash, I would do an owner carry and move on. I would sell the house and move on with the owner carry personally. That's how I would set these up if they're paying out of cash, not doing a piggyback loan. I know that gives me zero, involvement, guys, but I'm fully aware of that. But if they did an owner carry situation and they paid cash for the difference, you guys would get paid, they would move on, and they would assume it over the next 5 to 6 months, whatever that took. But you could sell a
So
house.
let's break that down though, Jordan. Let's break that down. That means we don't, in theory, we wouldn't have to wait for the servicer to knock out the assumable mortgage. The seller is going to seller with the seller is going to sell, owner financing the current mortgage balance because the buyer,
maybe, I don't know,
because the buyer has cash to make up the 100,000, 200,000, 500,000 in equity, theoretically. It also pays for the cost to sell, right? The selling cost, buyer, buyer, seller, agent commission, settlement fees, costs, etc. And then, it's
hopefully.
not
hopefully.
Yeah.
Yeah.
And then the buyer could continue to work towards, truly assuming the mortgage.
Yeah. So that's the situation that I'm kind of in, right? Is like it takes too long. I didn't want to wait, and especially when you have multiple deals on the line. That's what we did, we did an owner carry situation until it's finished out. I'm still in the middle of it, and it is a joy, I can promise you. But that to me is the cleanest, to get it done the quickest, right? To get your house sold the quickest. Otherwise, on a piggyback loan, you're going to wait until the assumption is done when you're piggybacking, or seller financing. You could do it with seller financing too, I guess. If they seller finance a portion of it and got the equity position, and got the difference in equity from there, you could do it that way as well. So
honestly, if the seller's motivated enough, you could do a lease option until, there's if you have a motivated enough seller and you get creative, there are lots of ways to solve their problem. Most of us have not been in markets where this is a relevant conversation for the last several years, right? Because just about anything sells fast and over asking, but that won't last forever. It never does. And so being able to being equipped with information and knowledge so that when you're having a conversation, you know the questions to ask, you know what information to look for, and how to set expectations and be transparent, etc., is how you win more business.
So you said something there, and I always like, anytime we do any sort of explanation on assumption words, I like practicality. It's like, what do we actually need to ask? What I get a lead, what do I say?
Mhm.
You know, as someone that wants to assume a mortgage. The first one I would say is, do we know what the loan amount is, and do we know how much the house is worth? You know, that'd be my first question. Can we get a copy of the mortgage statement? You know, usually the copy of the mortgage statement is going to be the easiest route. Anyone that's doing a piggyback loan, if you gave them the copy of the mortgage statement, that's going to be your number one. And the rest are going to be general questions of, because a lot of times these aren't, you know, you might not be sending this to a lender right away that can ask these questions. So you might ask a few lender questions as, do you know what your credit score is? Right? How are you going to pay for the difference of equity? You know, are you trying to try to get a loan? Do you know what your options are? Possibly. And then, you know, what do you do for work? How much money you make, kind of thing, if you want to get into, you know, deep into it. But the first question I would ask anything is like, how much, you know, the biggest obstacle is going to be coming up with the funds. Maybe not for some people, but for most, I would say they're going to need some sort of piggyback loan or a seller finance deal or something like that. So I would want to broach that subject as soon as possible, and know what you're getting into right away. Because the last thing we want you to do is spinning your wheels on people that, hey, I have no money, I want to do a seller finance on the whole thing. Now I got to find a house that's assumable, that the seller is willing to, you know, fork out, you know, money at closing, essentially, for everyone's commissions and, you know, fees or whatever.
And see, that's the balance, right? Because we don't want to lose those potential buyers or sellers that are open to these, or they've heard something about it and they want to better understand it. I think that's the right strategy. We want to be able to attract them, and instead of just the elevator pitch, have a more thorough dialogue so they can really understand what that process looks like, and help them figure out, you know, how much of this are they willing to, you know, take on to go after this approach. But then the second part of it is we also don't. Oh, sorry, Josh, you're muted. I just seen you there, bud. Yeah.
You said something there that made me think, because I'm sure we've all had this experience. The buyer that thinks they can buy a foreclosure for like 10% of value, right?
Bingo.
And so when you can give them an educated answer, some of those folks, you can turn from unrealistic expectations to coming back to reality, and you have the opportunity to serve them. The same goes for this. As this becomes more mainstream, quote unquote, you're going to have more conversations with people that are asking about this. So if you can provide an educated response, and you can demonstrate that you're the knowledge broker, that you know what you're talking about here, you have a greater likelihood of earning the trust from that client and the opportunity to help and serve that client, whether it's on the listing or the buyer side. Whether or not, I mean, and the reality is, it is going to be a very small percentage of people that this is going to be a possibility for. Just like when, you know, we probably have all heard the numbers, like out of 100 home sellers that request a cash offer, 3 to 5% of them tops accept that. It's the same thing, right? Like, but 45% of them are going to sell their house in the next 6 to 12 months.
Yeah.
So, like, you know, yeah, be there and be the knowledge broker.
That's perfect, Josh, because that's exactly it. Like, we don't want to lose these opportunities, because yes, maybe 3 to 5% of them will be in a position and willing to go through the process of finding that assumable loan home purchase, but 90% of them are excited about the idea of assuming a loan.
Right.
So we want to be the one to help them filter through that process, because that means we get to service people to do so, and I trust that we'll do it in the right way.
I've had someone, just as, you know, example there, I had someone that contacted me about a piggyback loan for assumption. And the assumption was like 65% of whatever they were buying. And they found out the difference. It would cost them more money per month to do the assumption, because the second mortgage was so much. That's a perfect example. They just ended up buying traditional. That's all they did. You know, I ended up getting the buyer still, and they still bought.
one thing we didn't talk about, that's an example of like the blended rate, right? So like if it's a low rate on a 50% of the equity and we're getting a high rate on a 40% carryback, and I'm just throwing out numbers for whatever, you still want to blend those together to get the rate or the total payment. And it might not make sense. It might be more than what Jordan just said. Let's just get a fresh first position mortgage. Yes, it sounds wonderful to have a first mortgage at 2.75, but the reality is that's just part of what you're going to have to pay monthly, right? So you have to look at the picture, the total picture.
Mm-hmm.
And I think this is where I want us to ultimately get to as well. But understand that sometimes we are just not in the right position to look at the numbers on this high of a level to not only help our clients understand whether or not their approach makes sense, but number two, how to properly communicate to them how there might be a better solution. So I know that the ideal scenario I want to ask you guys is when we start working with someone who has the idea of going through the process of buying a home and assuming a loan, I think it makes so much sense to get them in front of you as soon as possible. I would even argue if they have the cash, maybe it still doesn't make sense for them to do that assumption purchase. Maybe there are smarter ways for them to leverage their money based on their goals. But who's going to be the one in the best position to help them figure that out? And I know for me, it's not me. It's you two guys. So you start going through this process of attracting buyers specifically with the idea of buying a home and getting an assumable mortgage. My recommendation is let's get them in front of Jordan and Josh as soon as possible so they can help understand the nuance on the finance side. We're going to help them understand the nuance on the real estate side. And like they mentioned, that might put us in a position where we're going to have buyers who are clear, even if they want to go down the approach of buying a home with an assumable mortgage, what that's actually going to look like. So we're not spinning our wheels, wasting our time and getting frustrated. But also more likely than not, weeding out the people who are just solely focused on that and don't even, that's the only thing they would do versus converting some of them over to going, that's great if it comes up, but now I know I'm qualified. Josh and Jordan put me in a position to understand just how, unlikely that is anyway, but let's go look for a home in a more traditional fashion.
Absolutely.
Yeah.
And if you do have a willing and able seller, we'd love to have a conversation about that as well, so we can proactively, address you've got a ready, willing, and able seller. Yeah, they'll sell it with an assumable mortgage because they have a flexible schedule to move. Maybe they already have a second home that they're going to make their first home, right? That's a totally normal scenario. So there's not like this super urgency. Well, let's proactively address that when we start to get buyer interest, but they're like, well, I don't have 400,000 sitting in the bank to buy it, but I love this place. Let's proactively help with the marketing of that, or at least give you the ammunition so that when they start asking those questions, you can say, yeah, well, here there are a couple of different ways that we can approach this. Here are some of the basic qualifications. I'd love to get you over to Jordan or I or Daniel or Maria. I mean, we've got a great team that we'd love to help in those scenarios.
Yeah, that's thank you, because I didn't even consider that, Josh. You're right. It may make sense for you guys in terms of more market capture for us to work with you even on the listing side. And that's super gracious. I appreciate that. As we wrap for the day, do you guys you have a little bit of time to answer some questions that are out there?
Yeah.
Of course.
Okay,
Yeah.
cool.
Of course.
Perfect.
Also, for those just listening, I put for those that don't know me, I have my name, my NEXA email. You can find my EXP email as well. Either one, they end up in the same inbox. I've got my cell phone, my little landing page that has a bunch of different links on there for those that want to check out some different stuff. And then I have Jordan's name, email, and phone as well. Feel free to reach out to us, but we'd love to answer questions.
I think for a lot of us, we know, like when we start talking to a buyer, they're like, hey, I want to go buy a home that, and get an assumable mortgage. I know for a lot of us, we very lightly understood a lot of the nuance behind it. So our dialogue is somewhat watered down in that way too, where it's like, well, that's a really complicated process. But that doesn't sound like a solution provider to the buyer, right? That sounds like an agent who's trying to resist their approach. That's why these conversations are so powerful, because now we better understand, and you don't try to convince them on conversation one that it's wrong or bad. Instead, what you do
And
is
I think if you excitedly embrace the idea, you draw
Yes.
them in, you excitedly embrace it. Yeah, that can be a wonderful strategy to buy a home. I'm so glad you brought it up. Here are some of the pros and cons. And you let the idea it's then what you want to do is equip them so it becomes their idea that it might not be the best route to go. Or they might decide, okay, I'm okay with all. It's just like, it's very similar to if any of you have helped a buyer purchase a short sale, right? Like you got to set the expectations. Okay, here's the scenario. Yes, we can absolutely try and buy this short sale home. Here's what you need to know up front. You know, timelines, expectations, etc. We're gonna have to jump through some additional hoops that we might not have to on a non-short sale. The timeline, we're on the bank's timeline, not our own. We don't have control over it, right? And there's going to be, when we get progress, like we gotta comply quickly, right? Like when we get them moving forward, it's the same general idea. When you're talking about this type of opportunity with a client.
Okay, and for everyone, this is why we're so extremely lucky to have gentlemen like Josh and Jordan, because think about this. Not only do they understand the nuance, the practicality of this approach, what it's really going to look like, but they know how to sell. It's hard to find people who can do both. And so we're really lucky to have you guys on, because as Josh just mentioned, that's sales technique. If you just approach a buyer and try to shut them down or tell them, yeah, you can buy an assumable loan, it's really unlikely to happen, it's really difficult to do, you're creating friction. Like Josh said, embrace it with energy, with some enthusiasm, because you're making them feel good about some of their ideas. And because you didn't reject them, instead you embrace them, they are far more likely to listen to you now about what your expertise is and how they may need to consider other things is involved in that process. So that's an excellent way to help us understand, the sales side of these things. And that's where you excel, Josh. Like you're incredible in that way.
Appreciate it.
What other
Proof's not
questions
bad
you guys have?
Yeah.
What are some other questions out there?
Or general lending questions. Doesn't necessarily have to be about this either.
There you
Robert's
go.
got a great. Robert bought his first home with a assumed seller VA and a seller carryback. And
Nice.
then he paid the closing costs and commissions. So that's pretty cool. I'm telling you, I mean, who knows where the market will go in the next couple of years. So like this might be something, depending on your market, where, if you're the one that can have the educated conversations with folks, and then, what happens is if you successfully navigate it a few times, then you start to get more opportunities, right? And not just the ones, the difficult ones, but you get the easy ones too, which very transparently, that's kind of like our strategy on the mortgage side. We'll help you with the hard stuff, so that hopefully we give you some confidence that you'll give us the easy ones too.
Yep. I love it. And think about this for all of us on this call. Like you have an opportunity today, like implement today, to put something out there to attract people in your own database, your own sphere of influence, who are sitting on the fence, who are of a lot of the other buyers thinking, man, I'm going to buy once the rates change, right? And this could spark their engagement with you. That could get them off the fence, put them in a position that they may not even realize they're in a position to buy. And let's say worst case scenario, they still wait until rates change. Well, now you're building a deeper, more relationship with them about their home purchase well in advance. So there's no downside really to leveraging this conversation to get buyers to raise their hands, because now they get to work with you and they get to work with Josh and they get to work with Jordan to really unpack what's possible for them. And I don't think that can hurt anybody. Well, gentlemen, thank you. Thank you guys very much for this. As you guys know, all the contact information for both Josh and Jordan is in the chat box. So take a moment to grab that. as you have dialogue with buyers who maybe they bring it up to you, now you know who to go to maybe start in a more effective way talking through what this is going to look like and see if it's really a solution for them. And if it is, you get to facilitate it. So gentlemen, you guys are always the best. Love having you on here. Thank you so much. For
No
all of you
problem.
guys, reach out to these guys. They are incredible, especially when it comes to how to position us so we can not only have the right mortgage products to support our clients as markets change, but how to market to them so that we can all capture them and work together. So you guys are amazing. I appreciate you. Everyone, have a great week. Hopefully I'll see a majority of you guys in Southern California at the rally tomorrow. Otherwise, we'll see you right back here next Monday. Have a good one, guys. See ya.
All right.
Thanks, Joseph.
Thank
Appreciate
you
you all.
guys very much. See you guys.